This is Simplify Enhanced Income ETF, ticker symbol HIGH. In this video, we'll discuss what is high, how is high managed, why consider investing in high, and finally, how to use high in a portfolio. High seeks a high level of monthly income by combining investments in fixed income securities with an options selling strategy. The fund starts by investing nearly all of its assets in U.S. Treasury bills. Then on top of that, it sells short-term put and or call spreads on various instruments to generate additional option income. But first, what is an option spread? The spreads that High uses begin by selling an out-of-the-money option and buying an even further out-of-the-money option. This is done on the same underlying asset in the same quantity and with the same expiration date. Let's look at an example of a put option spread. Here we're looking at the option chain for a security with a current price of about $160. Step 1 might be selling a put option that's slightly out of the money, in this case with a strike price of $152.50. Step 2 would be to buy an option that's even further out of the money, for example, at a strike of $135. If you look at the bid-ask prices of these two options, you'll note that the option that's been sold has a much higher price than the option that's being bought. The difference between these two prices results in a net credit to the fund's assets. That's why this type of spread is sometimes called a credit spread. Now let's look at an example of a call spread on the same security. It involves selling a closer to the money call option, for example at $167.50, and then buying a further out of the money option, say at $185. Here again, the difference in these two option prices results in a net credit to the fund. Selling the closer to the money option generates income. Buying the further out of the money option provides a downside hedge in case the underlying asset price moves against the position. The ideal scenario is for all of the options to expire worthless. The fund would thus retain the entire net credit. What types of underlying instruments will be used for the options overlay? The fund might sell spreads on equity indexes and or ETFs and fixed income indexes and or ETFs. It might also sell spreads on individual securities. In the future, the fund might include other asset classes as well. The idea is that diversification reduces the risk that a single asset will move adversely. On the ETF page of the Simplify website, you'll see the fund's holdings updated daily. Holdings can change at any time, so this look at the holdings is just for example purposes. You can see that nearly 100% of the fund's assets are invested in U.S. Treasury bills. The first option spread is on S&P 500 index options. The fund has sold a put option and purchased an identical amount of put options with the same expiration date. You'll notice that the fund has two sets of short-term put spreads, each spread 1 week apart to minimize timing risk. The next couple of spreads are call spreads on TLT, a long-term U.S. Treasury bond ETF. So on this date, the fund was diversified between equity put spreads and fixed income call spreads. What determines whether the fund initiates a put spread versus a call spread? That is largely going to be a function of which type of spreads deliver the most income as well as offer the most correlation benefits. On the equity side, the fund will be biased towards selling put spreads because put spreads usually deliver more income and stocks are up slightly more often than they are down, making put options the higher percentage play. Now let's look at the moneyness of the short option. The closer to the money the short option is, the higher the income. That's because an option that's closer to the money is more likely to expire in the money, so therefore it has a higher price. But if it's more likely to expire in the money, it results in a lower winning percentage. Remember, a win means that the option expires out of the money. Moving to the upper left, we can see that going further away from the money will result in lower income because those options are less expensive. However, being further out of the money means that the win percentage will be higher. High uses a systematic process to find the sweet spot to help meet the income goals of the fund while keeping the win rate as high as possible. How does High manage risk? High manages risk in three primary ways. The long option provides some protection against a large adverse move in the underlying asset price. Diversifying among several types of options reduces the idiosyncratic risk of a single asset price moving adversely. Finally, the fund utilizes systematic stop-loss and risk reduction procedures in times of extreme volatility. Why consider investing in High? Typical strategies that investors use to increase yield include extending duration or moving down in credit quality. Another way investors reach for yield is to invest in some niche equity sectors such as master limited partnerships or business development companies. Let's talk about duration. For the past 40 or more years, long-term U.S. Treasury bond yields have been falling. For much of the past decade, 30-year U.S. Treasury bond yields have remained under 4%, even considering 2022's yield increases. Given the high degree of volatility associated with long-dated bonds, along with relatively low yields, there is not much to be gained by extending duration. Moving down in credit quality by buying below investment-grade bonds can increase yield. However, high-yield bonds increase volatility as well as the potential for dramatic drawdowns. During the global financial crisis, the Bloomberg High Yield Bond Index declined 36%. High-yielding niche equity sectors can also exhibit dramatic drawdowns. The Illyrian MLP Index has had drawdowns of over 80%. High attempts to generate similar yields as high-yield bonds, but with significantly lower volatility. Now let's discuss how to use High in a portfolio. The first use case is to use High as a direct one-for-one replacement for high-yield bonds. The second use case is as a general yield-enhancing diversifier. Depending on what the investor is trying to accomplish, they can replace some of their bond or equity positions with High to lower volatility and/or increase income. Now for some Q&A. How far out of the money will High's options be? This will be determined by market conditions, but expect about 2.5% to 5% out of the money for the short option, and about 10 to 20% out of the money for the long option will be typical. What is the duration of the options contracts? The options will be short-term, typically with expiries under 1 month. What is the worst-case scenario for High? When all of the underlying assets experience an adverse tail risk event. For example, a significant downward move in an asset price when selling put spreads, or a significant upward move in asset prices when selling call spreads. What will High's correlation be with stocks and bonds? Equity put spreads will have a positive correlation with stocks. Equity call spreads will have a negative correlation with stocks. Bond put spreads will have a positive correlation with bonds. Bond call spreads will have a negative correlation with bonds. What is the fund's tax treatment? Gains will be distributed monthly and be treated as ordinary income. Thank you for watching this video. For more information on Simplify ETFs, please go to simplify.us/ETFs, email us at info@simplify.us, or call us at 646-585-0476. You can also book a meeting with us directly. From our homepage, just click the Contact Us button on the main menu. We look forward to speaking with you.